Good morning, everyone, and thank you very much for joining me. This is the morning market review with myself, Russell Shaw. I'm a senior market specialist at FXCM, and my email address r@fxcm.com. Today is Thursday, the 26th of May, and I still would like to do a sound check, guys. Can you guys hear me? Just want to double check. Okay, thanks, Anetta. Thanks for your email yesterday, Zinette. I'll certainly reply to that. Morning, Katie. Hey, Howard. Nice to have you guys on the webinar. All right, let's just bring up our high-risk investment warning. I'm going to keep this on screen for a few moments. And here's our market commentaries disclaimer. I'll just keep this on screen for a few moments as well. All right, and just our references. So there's a few things I want to just go through today. So that's why I've added investing.com, AmiBroker, and St. Louis Fed. We're going to use AmiBroker. I've just taken data from investing.com and from the St. Louis Fed and just popped it into AmiBroker because it's just easy ways to get there and then to analyze the data. We're going to start off with the CNBC morning note, and of course, most of the analysis will be done either on MarketScope or TradingView. All right, let's start off with the CNBC note. All right. Here it is. So my system is still so slow. Okay, it reads as follows. This is off of CNBC. European stocks set for cautious open as global markets react to the Fed minutes. So the Fed minutes were released yesterday. And European stocks are expected to open mixed Thursday as markets digest the latest signals from the US Federal Reserve regarding rate hikes. The cautious open expected for European stocks comes after a higher closing day as global markets try to bounce back from a widespread retreat in the previous session. The US stocks rose Wednesday after the minutes of the Federal Reserve's May policy meeting showed the central bank is prepared to raise rates further than the market had anticipated. I don't know why anybody's surprised about that. We've suggested that above 3% is a real possibility, and 4% is quite likely. I mean, they've got a real problem on their hands with inflation. The minutes from the Fed's May 34th meeting showed officials saw the need to raise rates quickly and possibly more than the market has priced in to quell the recent inflationary pressures. Asia Pacific stocks struggled for direction in Thursday morning trade as investors reacted to the Fed's minutes. US stock futures were also mixed Wednesday evening as investors digested a disappointing update from NVIDIA, an economic bellwether in the tech sector. In the last day of the World Economic Forum on Thursday, it's the last day, of the World Economic Forum on Thursday, bringing to an end an event that sees global business and political leaders come together to discuss the world's most pressing problems, with the war in Ukraine topping the agenda. And that's where we'll leave that. All right, let's bring up AmiBroker. All right, so this is AmiBroker. The reason I wanted to bring this up was that I read an article yesterday on CNBC talking about the US consumer. And the article said, there's still a lot of savings. They're not concerned about the US consumer, and my assessment is actually the opposite. And you know, we'll just have to see. We'll just have to see that the we'll just have to see how the I guess it develops. Actually, Eric, no worries. Yeah, I saw that I had the account on the screen. No worries. Okay, so what we want to do is we just want to take a look and see how healthy is the US consumer. How healthy is the US consumer? And just get a new one here. And the reason that we want to know how healthy the US consumer is, one of the best ways to kind of see it is in terms of the gross domestic product function, which effectively goes like this. So gross domestic product, which is the amount that amount of production that is produced within a country in a given period. I don't know why my system's so slow. I'm begging your pardon. So what we're going to do is we're going to see that consumption makes is a major factor. It's a major component of gross domestic product. And I'm so sorry. Let's do it. Let's do it like this. All right. Okay, so GDP equals, okay, consumption. C stands for consumption plus investment, okay, plus government spending, okay, plus exports, because all the goods you're exporting out, you're receiving money for, minus your imports, because whatever you importing, your money is going out. So that's a function where X stands for exports and Z stands for imports. Now, the key here is C. C is the biggest component of GDP. What is C? C is consumption. Okay, that's why we look at the consumer price index and give it such import. Retail sales. That's why we get retail sales such a lot of attention. Non-farm payrolls. We give it because we need people to be employed so that the consumption function is effectively safe and secure, right? So that's so we've got a very interesting situation that is developing. And what is the situation that's developing? Well, we're getting what's called a stagflationary environment. Now, we're having the stagflationary pressures. We're having these stagflationary pressures at a time when unemployment seems to be pretty good by what we call the U3 definition. Okay, U3. U3 is quite a narrow definition, but it's the one that we see the most, narrow definition. The broader definition is what we call U6, but I would suggest we all are very comfortable with U3, and we'll use the U3, which is currently at 3.6%. We're talking US here, okay? So it seems that we're going into this stagflationary environment where all seems good on the job front, okay? And if everything's good on the job front, then hopefully, consumption and the consumer serves as a buffer to the stagflationary pressures which are starting to manifest now. And I would suggest that is a part of the Fed's strategy. Yes, they have to raise interest rates, and the reason that they are prepared to raise interest rates is because there is a a buffer year. They've acknowledged, yes, there is going to be pain. Okay, what do they mean by pain? It means that this unemployment rate is going to creep up. It's going to increase. They've acknowledged that, and our own analysis, okay, our own analysis on this webinar suggests similar. How do we get that? Well, I'll just go back to Trading View and well, I'll just need to wait for it to load. But what I was going to show you is we've seen the PPI interacting with the US core CPI, and then what we've actually done previously is we've added the unemployment rate on, haven't we? And we've seen that the unemployment rate is at a place where it's extremely vulnerable now. Let's just do that now that Trading View has loaded up. Let's just do that. I don't want to get too involved in the analysis, but I just want us to all be on the same page here. So if we put in the US PPI, okay, year on year, okay, let's pop it in. So we should all be very comfortable with this series now. Let's just take this out of logarithmic. Okay, we don't need it for this because it's a percentage. So you guys have seen this previously, and what we're going to do here is we're going to add the CPI. Okay. Again, I would say that you guys have seen this, and I think that you're comfortable with it. If you aren't, of course, just ask the questions. But let's just pop this in. Okay. But for the discussion, U3 is a definition of unemployment. So, Katie, it's ignoring underemployed people. It's ignoring I guess it doesn't include the participation rate is ignored out of that. It's a very narrow. It's what we see quoted constantly in the press. Okay. So the idea is when we do non-farm payrolls and receive the unemployment rate released, that is U3 that but we're not seeing U6. I'll see if my system is very slow today, and I'm begging your pardon, but I will certainly show you the difference if I have the bandwidth. Does that help? Just let me know. I'll look at it in more detail if I can. Now, here we've got unemployment. Here we've got PPI. That's the black series. We've got the CPI. That's the orange series. Let's add in U3. And it's okay to use U3 because U6, U3 tend to trend in similar directions. But there are important differences which we're probably going to have to look at in a probably tomorrow. But let's just add in the unemployment rate here. Okay. So this, I want to be very clear now. This is the narrow definition. Okay. Don't worry about it. It's going to serve our purpose here. Okay. So let's bring this in. Yeah, so Anna, that's terrific. Okay, so Anna has just brought the definition, Katie, from Investopedia, and it just I'm going to copy this and paste it in. Actually, this is terrific, Anna. Okay, I'm going to just send this to all you guys. This is from Investopedia. And you can see it, the U3 unemployment rate is the most commonly reported rate, representing the number of unemployed people actively seeking a job. U6 includes discouraged, unemployed, and unemployed workers. So it's a much narrower definition. That's terrific. Thank you. How does this factor in that it's currently difficult to get skilled staff in the US? That's a very good question, and I thought about that. And I'll propose a scenario, but all it is a scenario. It's not something that I can say is 100% correct. So that's a terrific point, okay? But what we have here, let's just take a look at the unemployment rate. That's this sort of toysy color, and you can see it's very low. It's very low. It's 3.6%. It's this blue little label here. It's very, very low. Now, that of course is good for consumption. It's good for the fact that we've gone into the stagflationary environment, that we've got this, dare I say, buffer. Because imagine going into a stagflationary scenario when you've got incredibly high unemployment. That would really be disastrous. So the fact that we've got this at 3.6% seems to be indicating that we are, at least shielded to some extent. All right. What we're going to do now is we're going to add in the next series. This will be the last series that I'm adding. I want to put in 2 more series. I'm begging your pardon. I know it's getting messy. And then I want to go back to the health of the US consumer. But just bear with me. Okay, I'll try and be as clear as possible. I want to add in the GDP growth. Okay, let's add in GDP growth. Okay, so let's add that in, and I'll take the reason I'll add in GDP growth now is because I'm going to take it out just to give it some space. Let's just add it in. US GDP growth year on year. Okay. Which is this yellow series now. Now, geez, we got a lot on our plate here. So let's just see if we can narrow it down segment by segment by segment and see if we can make it easier. So let's just take a look at this area first. This is the first oil crisis. Okay, this is the first oil crisis, and you can see that as the PPI, that's the black series, moves up, you've got CPI pushing up after it. That's the orange. Okay, you can see the labels here if you get confused. So this is the first oil crisis. You've also got your GDP growth. Take a look. GDP growth is actually moving up until it hits its apex, and then it comes down. Okay. Then it's coming down. Now, it's coming down as PPI and CPI increase. Now, this turquoise is unemployment. Let's just move this. Let's move this to the apex of GDP growth. Take a look at unemployment. This is the unemployment. The unemployment rate U3 is a lagging indicator because it's reported after the fact. It's a lagging indicator. So GDP starts coming down. Guess what's happening to unemployment? Starting to increase. Okay. Let's go to the next segment. This is the second oil crisis. Okay. Let's just try to find the apex for GDP here. It's round about there. Okay, it's round about there. Okay, take a look. Here's the lag in terms of unemployment, but eventually unemployment kicks up as the GDP rate is coming down. Okay, so those are the 2 big stagflationary crises: 1973, 1979. 79 is called the Volcker years. 79 into the 80s is the Volcker years. He was extremely aggressive with his rate hikes, Paul Volcker, in controlling inflation. And of course, we've got to add in the Fed's funds rate, which we don't have here yet. I'll add it in a moment because I want to take GDP off. Here, take a look what's happening at our current situation. Unemployment starting to come down steeply. Look how steep this decline is. Beg your pardon. Sorry, let me be very clear. I want to be clear. This is not unemployment, it's GDP growth. Sorry, GDP growth is coming down very, very steeply. Very, very steeply. Now, we haven't seen any reaction in unemployment here, but we know that it lags. Okay, it lagged in 1973. It lagged in 1979. Okay, there's a lag there. All right. Now, what's the big difference between the previous oil crises and the 2022 supply shocks? I'm going to take out GDP because it's too busy. So I'm going to just delete that, but just understand that we are in a situation now where GDP growth is coming down at a rapid pace, okay? Now, keep that in mind. GDP is coming down. That's key. It's a key part of this discussion. GDP is coming down, okay? Because we're going to look at that in a bit more detail, all right? But let's just take it off for now. I don't want to be. And now let's add in the Fed funds rate. Okay, now we add in the Fed funds rate. Now, what's the difference between the oil crisis and 2020? Well, it's actually the Fed funds rate. The Fed is way behind the curve here. Now, the yellow is actually the Fed fund rate. Remember, we've taken out GDP. So the system's just taking the yellow and using that for the Fed's fund rate. And you can see that the Fed's fund rate moves up very quickly. Just before, here's the Fed's fund rate starting to move up. This blue dash, that's where GDP is, it reaches its apex. And then we get unemployment increasing. And similarly, in 1979, you can see Volcker here is pushing up the Fed funds rate very aggressively. GDP peaks, okay, and then unemployment bottoms and then goes up. Well, we're so far behind here. See, the Federal Reserve, the fact that they've come out with minutes that are saying, well, we need to get rates higher. I mean, we're not surprised by that. They are way behind compared to where they were in previous crises. And this stagflationary pressures is still very much alive. It's alive until, I propose, until the black PPI drops below the orange CPI. So it's very much still alive. Now, we've seen GDP has started to decrease. Now, GDP is the amount. Remember, I said it's very important that we understand that. GDP is effectively the coal for employment. If your GDP stops moving up, if it starts decreasing, well, you don't need as many employees. You need less laborers, you need less employees in the office. Obviously, the unemployment rate is at risk. So, Anna, the answer to your question was, what about it's so difficult to currently get staff in the US office? I don't think that's going to be a factor if companies need to adjust for the macroeconomic environment that's taking place. We see GDP coming down. Interest rates haven't started moving yet, but we're constantly getting this communication that they are going to move. So I think that oil engineers are an example. Fair enough. But that's one sector, right, of the employment sector. There would probably have been, in the previous crises, pockets of employees that benefited because their industries were growing within the inflationary environment. But on a macro aggregate scale, that's certainly not the case. On an aggregate scale, unemployment looks to be very vulnerable at the moment. Now, let's take this to the next step, okay? Just how vulnerable is consumption? Just how vulnerable is consumption? Because consumption is 70% of that GDP equation that we have written down here. So the first thing I want to do is, I want to go to lightweight vehicles. That's where I want to start the analysis. And so this is a series of the sales of lightweight vehicles, and it's actually looking pretty good. At first glance, it's looking pretty good. So you've got this series that has actually taken out its 12-month simple moving average, well, that's positive. A stochastic, which is a measure of momentum, seems to be showing that the purchases of lightweight vehicles, it seems to be suggesting the momentum is increasing. That's what these green ellipses are. So the first chart that we're looking at actually looks not bad. So, but okay, I would suggest we need more proof here. Whenever we look at a moving average, well, the direction of the moving average is a extra filter, which is worth applying, and I think it's definitely worth applying here. We want to see this moving average move up. We want to see it turn and start moving in a positive direction. Otherwise, it could be, okay, otherwise, it's quite likely, quite possible that, I'm just trying to get this, I'm trying to get this, there we go. It's quite possible that it's sort of a whipsaw signal and it actually hits the moving average and falls. So we want to see this moving average actually turn up to act as an extra filter. Now, even the stochastic over here, it doesn't have the greatest gradient. It's quite flat. So the momentum here, I would suggest, is quite flat. And as Anna says, spending because of inflation, I would suggest, Anna, that as we go through the other series, that this, to me, my interpretation is this is an outlier. I don't think we're going to get the moving average turning up. I actually think that we're going to see this fall off. Okay, so the obvious question is, Russ, how can you say that? Because it looks like it's moving up. Let's take a look. Let's take a look at the other series. Okay, so the next series that we want to look at is what's called the Red Book Index. Okay, the Johnson's Red Book Index, which is this guy over here. And what the Red Book Index is, this is now a weekly. There's a weekly scale, so we're going to have to adjust this. There's no use having it as a 12. 12 is good if you're using it on a monthly scale, but this is now week data. So I want to change this to 52. Okay, so I'll just go through to my parameters here. And where is my system is so slow. Let me try that once more. Parameters. I'll try it once more, otherwise it's not really a big deal. All right. This is the Red Book Index. The Red Book is it's a series that's put together of chain stores, of your big retailers. You know, and we all know there's been news in the press lately of just Target and Massmart. Well, you can see that this moving average, just for some odd reason, my system is just not working properly this morning. Well, when you would do the 52-week, this green circle is actually where the Red Book Index falls below the 52-week average, and this red circle is actually where the 52-week average turns down. In other words, we were looking for the filter. We were looking for the filter on the light vehicle sales. Well, we've got the filter that's now been applied to chain stores, and take a look at the momentum. The momentum is falling. Momentum's falling to the lower quintile. Okay, so the fact that we're getting these bearish signals on chain stores is extremely concerning. Why chain stores? Because chain stores are not regional, they're national. Moreover, they're marketing powerhouses. So if they are starting to lose sales, well, what's happening to the rest of retail? So now we've got two kind of competing series. We've got the light vehicle sales, which suggest that, well, sales of the light vehicles are increasing. But when we look at the chain stores are showing sales are decreasing. Now, just to tell you what you're looking at here, We've currently got it at 11.4%. It's telling you that the chain stores sales are increasing by 11.4% week on week. So at first glance, that sounds really good. Well, your sales are increasing. No, that's not the way we interpret it. The way that we interpret it is that the sales are increasing at a decreasing rate. And back in December, chain store sales were increasing over 20% per week. They now have dropped down half of that and are threatening to go negative. Okay, once you increase at a decreasing rate, eventually you hit zero and go below it. So this is a very, very concerning chart. I just wish I could change my parameter here. For some odd reason, it's not letting me. All right, let's take a look at the next series. So we've looked at vehicles and we've looked at chain stores. Well, they're showing slightly different conclusions. Well, okay, KD steals my thunder here because he asked, is there a house purchase index? That is a brilliant question, KD, because that is exactly what we're going to be looking at next, the housing sector. All right, so let's see, existing home sales. Now, existing home sales, KD, is where the bulk of the action takes place in the housing sector. It's the bulk of it's where you've got existing supply. Generally, people are buying existing over new. Take a look what's happening here. Here, again, this is monthly data. Now, you can clearly see what's happening here. We're below the 12-month moving average. That 12-month moving average has turned down. This is since 2022 began, we've got a steep decline in the existing home sales. Take a look at the momentum. Okay, the momentum down here is reaching that 20. Now, remember, if we start hanging out in the 20 area, well, that's disastrous, right? Because that means there is an underlying momentum of weakness. So the housing sector here is coming down. The chain stores are showing weakness, but the lightweight vehicle sector is showing perhaps an anomalous bounce. Remember, vehicles and home sales are basically financed by debt. You know, we take out a mortgage, we take a car lease, whatever. The idea is interest rates are moving up. If this is increasing, well, that is a statement of sentiment. You will be prepared to take out a home loan or a car loan if you feel that your job is secure, if you feel that you are securely able to make those type of payments. Well, we're getting chain stores coming down, which are marketing monsters, right? We're getting existing home sales coming down, and then we've got the lightweight vehicles here, which is anomalous, sort of picking up. That's weird. All right, let's take this to the next series, because now it's starting to get the next two series that I'm going to show you, which are the final two series. These are the two series that are really scary. Okay, let's take a look at the University of Michigan consumer sentiment. All right, it's this. All right, this is a nasty looking chart. You guys can see it. It's a waterfall. Okay, so what the University of Michigan does is they make at least 500 telephone calls. They make at least 200. They make at least 500 telephone calls, and then they ask them 50 questions. And after they've got those 50 questions, they compiled using a methodology, and then the consumer sentiment index is released. And it may be that people are working from home, want to travel light, vehicle sales go up. It could be, Katie. You know, it could be. There's no doubt that the world has changed since 2020, and perhaps my thinking hasn't kept up with the new reality that we find ourselves in. I would concede that. I would concede that. So that could be a reason for the anomaly. However, this series here, well, this is kind of frontline data now, right? And it is looking scary. So this is sentiment now. You can see that it's below its 12-month moving average. That 12-month moving average is moving down. Take a look at your momentum. think about it of this. It's a strong momentum of gloominess. That's what we saw. It's a strong momentum of consumer negativity. So you can, and that is bad news. Why is it bad news? Because consumption makes up 70% of gross domestic product. Now think about it. Think how circular. Think about what we've talked about this morning. This is completely circular. If the sentiment is low, then consumption will tend to be low because people will spend more if they're feeling good, right? But if consumption comes down, then unemployment's going to tick up, and if unemployment ticks up, well, then your gloominess is going to increase. It's going to stay in the lower quintile. Then your consumption is going to bring GDP down even further, and it's circular. This is kind of what the Fed's facing. This is what we're all facing globally. Katie actually asked if we can look at the UK consumer. I'll have to prepare something on that, Katie. I don't have that kind of data available, but it's on AmiBroker. I'll source it, and we can do a similar type of analysis. What's good about the US is just how readily available the data is. It's very accessible. UK data would also be easily accessible, but it's not quite as accessible as the US. But I would suggest that the US is a proxy generally for global industrial countries. I would suggest that, subject to correction. But I think that it's a good point. We should take a look. If I can get the UK data, let's do that tomorrow. But you can see that the consumer index here is abysmal, but to the point that it's extremely worrying. As an economist, you've got to be concerned about this because we're heading into a stagflationary environment. And not only are we going into a stagflationary environment, okay, we're thinking that the job market's going to be some sort of buffer and keep that consumption up, which brings us to our last series, the one that I think that we've got to pay the most attention to, okay, and that is average weekly hours. Let's see if I can find that. Average weekly hours. This is a terrible chart. Okay, this is a terrible chart. This is an indictment. Now, what you can see here is that the average weekly hours are coming down. The green shows where we've crossed the 12-month moving average. The moving average, the red, is where we actually see the moving average turn negative. So there we are applying the filter. Remember, we must be consistent. So we want to see the filter apply to the lightweight vehicles. So we're applying it to the rest as well. In all the others, the filter is not good news. Now take a look at the stochastic. Okay, the stochastic has fallen into the low quintile. The stochastic is the percent K. The percent D is just a signaling line. It's a three. Sorry, in this example, it's a 5-period EMA of the percent K. That's what we're looking at. So the percent K is negative. Is in the weak momentum area. In other words, the average weekly hours is set to fall even further. What's the big deal about this? Okay, the big deal is people. I'm of the opinion, yes, there are sort of people out there that really don't care, but I would suggest that most of us are caring individuals, including employers. Yes, business is business, but by and large, if an employer can keep an employee on, they will do that. And not just because they are caring, it makes sense in terms of business, because the employee's trained, he knows the processes, you don't have to spend money retraining. So what you'll do, before you start laying off employees, you'll start cutting back on their hours because you don't need them, okay? And that's the way that you can save on your costs. You say, instead of me paying you overtime, don't have to come into the office, okay? So remember what I said, unemployment is a lagging indicator because it comes in after the fact. Average weekly hours is coincident, it's not lagging. Average weekly hours is coincident, it's happening real time. So what happens is employers tend to cut back on hours that they need the employees before they lay off, okay? Similarly, by the way, at the bottom of cycles, before they start hiring, they will start increasing the weekly hours, and then eventually thresholds are reached where you have to add to your workforce, or in this situation, a threshold is hit where unfortunately you're going to have to start laying off. That's the real danger here. Okay, now that brings us back to this graph. Yes, we're at 3.6%. Let's not get too comfortable with that. Average weekly hours have started to fall and are at the lower quintile in terms of momentum. Eventually, a threshold will be hit where employers are going to have to make tough choices. Now, when does that happen? Well, the Fed, unfortunately, the Fed's going to be stoking the fire here because they have to raise rates. They have to raise rates because we're in a stagflationary environment. There's a choice to be made when stagflation. Do you promote GDP growth, or do you bring price stability back in line with targets? I would say almost, if not 100% of the time, then it's 99.9% of the time. Central banks are going to go with the price stability mandate. Okay, and that is kind of, we're right on the cusp of that. We're kind of on the tipping point, and this is going to be a very interesting exercise to see just how this plays out. Can the Fed manufacture a soft landing? What we're looking at, what we've looked at this morning, suggests no. I'm hoping that they can. Everybody hopes that they can, but the history is against that. So, and the current economic series that we've looked at this morning are against that. What about lightweight vehicles? Well, Katie, I think, makes a good point. Perhaps the world has changed over the last 2 years, that maybe the analysis of it has to be different. Or the other point is, perhaps it's just an outlier and we will have to wait for that moving average filter to effectively turn up. What does that mean to us as traders? Okay, this is the last point. Okay, this is the last point. Let's just add in our S&P 500 over here. Employees are more choosy about what they do. COVID has made more activities online. I would agree with that, Lisa. I generally work from home. I do go into the office on the odd occasion. What I'm suggesting, though, is that we're at a tipping point. I'm hoping what you write there continues. But if history has anything to say about it, we are at a very risky time in this cycle. And you know, the more things change, the more they stay the same. I think there is one constant here, and what's that constant? It's wage expense, salary expense. You know, a company still has to cover that despite where their employees are situated. So let us keep an eye on this. I think that we are in a very, very precarious part of this economic cycle. We are traders. We've done, I think, a very thorough analysis now. What does that mean for us as traders? Is there places for us that we can take advantage? And of course there are, because as traders we can play the long side or the short side. And so what we're going to do here is we're going to add just the S&P 500 as a proxy for risk markets. So we'll add this in, SPX. I'm going to pop this not on the same chart. I'm going to pop this on a separate chart below it. Okay, and this is where I think getting pretty close to concluding here. Now, what we want to do here is just change this to logarithmic. Just this price chart, must change to logarithmic. It's just going to make it easy for us to see. And you can see that once we get this, as we approach this in unemployment, 73, the market tanks. As we get this pickup in unemployment, okay, this is quite odd. It does move sideways, picks up, and then perhaps comes down. Over here, we go through to, this is not really stagflation, but as we see unemployment ticking up here in the tech rec, you can see that the market tanks. As we see unemployment picking up, this is now the global financial crisis over here. You can see that the stock market tanks, which of course now brings us here. And this is how we're going to. What is going to happen? Are we going to have that soft landing? Has the world changed that the analysis needs to change? Lisa says that the employment dynamic has changed, and of course, Katie says perhaps the light vehicle dynamic has changed, and I would accept both of those because clearly the world has changed over the last 20 years. But we are what we can at least say is that we are at a very precarious point in the economy. We need to be very savvy in seeing how it plays out. All of us need to be very savvy to see if there is a softer landing this time round. If there's any questions, go ahead, type those in. Zanetta just writing, very interesting because the MA on the full hour US dollar still holds. Yeah, all right. Any comments, please go ahead and I thank you very much for your comments. I think that all points this morning have been terrific. And and Lisa says, and we're spending dollars on Chinese products. Yeah, I think then if there's any comments, you can of course send it through to me via email, and I'll see if I can source some more information for economics tomorrow. Otherwise, we haven't looked at the price charts though. That's another thing that we may cover tomorrow. So thanks very much for joining me this morning. Have a good day ahead, and of course, we'll catch up tomorrow morning. Thanks very much, guys.